but you have all these cases where like the receiver will go take this opportunity to market and then they don't even end up selling it. That used to be like the golden goose is receivership would always result in a transaction. And now it doesn't today.
Well, that might also boil down to the incentive model for receivers of how they're paid.
Right.
They're paid a retainer on a monthly basis. So previously in the US, like these receiver sales, they were typically fire sales because the receiver's job is to get rid of the asset.
Yeah.
So it depends on the receiver's business model.
Gotcha.
If the receiver's, the business model is to just hold on to things. And we have this issue with what we call servicing and special servicing in the US, where they don't technically have a fiduciary duty. They have a contractual obligation to maximize value. So let's say, when Westfield, Unibail Rodamco left North America and just passed all those distressed malls to special servicing, they just sat in the portfolios and the special servicers managed them, clip coupons. We bid on some of those opportunities. But then when you read the fine print of what a servicer is supposed to do, they're actually not fiduciaries.
Right.
They're providing a service. Mm-hmm. And so maybe there's some of that up here.
Just a little bit.
A little bit.
Yeah.
But also a lot of it boils down to, and I'm not throwing my arms up and saying this is the government's fault. The banks in the US didn't start clearing their books until the regulators of those banks started coming around and asking, show me your books.
Yeah.
So the big banks, we'll call them the systemically important banks, they were in a rush to clean things up. Mm. And like some banks were quicker to the punch than others. Actually, CIBC US, based out of Chicago, was extremely aggressive about clearing their books. Shout out to Carol, a longtime coworker from back in the day. But then you had some regional smaller banks that just said, nothing to see here, move along.
Right.
And so, we would, in New York, we'd see all these distressed loans. They're very easy to find. An office building that's perhaps empty and has $100 million loan. Like, I wonder what's happening. You call their bank and say, like, we're not interested in talking about this right now.
Right.
And so it wasn't until that regulator, the Office of Comptroller and Currency, or kind of the FDIC saying, you are way out of whack on your capital ratio because you have huge losses on your books. And,
right.
That'll probably or may not happen here. When I think I don't know who your regulators are, but maybe like OFSI or something like that.
Yeah, I think so. Or OSC, depending on.
Yeah. So if they looked at the balance sheet and go like, oh my gosh, like your commercial loan balance sheet is like, 30% impaired.
Right.
You need to fix this. So until that happens, there's a good chance nothing will happen.